This is actually something that I see a lot of new investors do. If this is your first time to my channel, my name is Dion. I reached financial freedom by buying and hold real estate. It took about a decade to reach financial freedom, and now my goal is to teach you that the average individual can reach financial freedom and make work completely optional in 10 years or less, even if you're not starting from the best position. And one of the things that we need to do if we invest in real estate or almost any asset class is to study that asset class and figure out how it works. When I first started investing in real estate, I made some huge mistakes. My first year, I lost money. I didn't know how to run the numbers on my cash flow. I didn't know what cash flow was. I was still thinking per door metrics, or wasn't thinking at all is what it seems like when I look back at it. But in those first couple of years, I thought I was going to replace my income by investing in real estate with no education. Right? I had been a Marine, 13-week boot camp. I was a police officer, 6-month academy. I knew that it took time, education, and dedication to work in almost any field, but I thought I would replace my income by investing in real estate without any education. And I lost money that first year. I did so poorly that I tried to quit, but luckily, because luck is a factor, I was underwater on that property and couldn't even give it away. I did so bad that first year, I tried to give it away and couldn't. So I was stuck with it, and it ended up being one of the reasons why I was able to reach financial freedom, retire last year, and never have to work again in my life because I was stuck with that property. What I realized is that I needed to educate myself. Hopefully, like some of the people watching my channel right now, your goal is to educate you in how investing works, how financial freedom is possible. Then you can choose your path, whether it's starting and growing a business and getting it to the point where it's so large somebody else runs the day-to-day, investing in real estate, investing in stocks, using the 4% rule. I chose real estate. And when I really started to understand it, part of it was because I had some experience, but part of it was because I found the book Rich Dad Poor Dad, Cash Flow Quadrant. One rental at a time. I found the BiggerPockets forums. I found the BiggerPockets channel eventually. And I educated myself. I still do that. I still watch YouTube University. And what I'm going to do in this video is I'm going to talk about something that I saw on a channel that I watch, and I enjoy their content. I'm actually going to leave a link in the description below so you can check out this video too. During my live streams, on Tuesdays at 4 p.m. Pacific, I will answer any question you throw at me. Financial freedom, real estate, investing, any question. And sometimes people try to trip me up, and I totally understand that because I would do the same thing. But I was watching a channel that I enjoy, and they were posited a question. They read the question, then they give a pretty good answer, pretty detailed answer. And like I said, the link to that video is going to be in the description below after the end of this live. So you can go check out the video too and see what their advice was. But they were missing something. There's something that I would have used to answer this question that I think was missing from the mind of the person asking the question. So I still watch a lot of YouTube. I watch One Rental at a Time, Lumberjack Landlord, Millennial Mike, Matt the Mortgage Guy. Right. I'm still taking in content. I even watched Joe Kuhn, who invests in stocks and retired early using the buckets method, an investing strategy that I don't use, but there's a lot of stuff on his channel that I actually do incorporate in my option to retire early and how I look at money. So I recommend checking out all of those channels. But one of the channels that I watch, they do a live stream, kind of like mine. Theirs is about hours long. Mine is usually a couple hours long because I'll answer all the questions. But Ken McElroy is, in my mind, really associated with Robert Kiyosaki, who wrote Rich Dad, Poor Dad, and Cash Flow Quadrant. But Ken invests in syndications and large apartment complexes, has thousands of units. He's very successful under every metric that I can think of when it comes to investing. But he invests in a different format with a different goal than me. My goal wasn't the most number of units or a massive portfolio or generational wealth. My goal that I'm trying to share with some people is that it's possible to reach financial freedom with the goal of the right amount of cash flow with the least amount of units. So while Ken's great, I like him. What I really like about Ken's YouTube channel, Ken McElroy, is he does this with his wife. It's Ken and Danielle. Danielle has 3 or 4 rentals. She's more looking at it as an investor, reaching cash flow, not so much involved with syndications and large apartment complexes because she likes fixed rate debt. So I really like the dynamic between the two. So that's one of the channels that I still watch, like One Rental at a Time, Lumberjack Landlord, Millennial Mike. Content that I take in keeps me motivated, keeps me focused, reminds me why I reached financial freedom sometimes. But what I want to do is I want to play a little clip of Ken and Danielle of the question that came in, and then I'm going to give an answer because I want to prove to you that 3,600 minus 3,200 is 4,000. And it all makes sense if you don't think about it. So here is, if I can figure the tech out during a live stream, the question that they were asked.
And Chad's question, it's a really good one. It says, during a tenant turnover, what is the average percentage of annual cash flow that it takes to get a home ready for the next tenant? For example, I'm cashing $3,600 annually, and I need to turn it over for the next tenant, and it costs me $3,200. This is basically most of my cash flow.
So the question comes in from Chad. And believe me, as a content creator, we appreciate the questions that come in during the live streams. And on my live streams on Tuesdays, I answer every question that comes in. The purpose of this video is to answer this question. I don't know that Chad watches my content, but he has $3,600 a month or a year coming in as cash flow. And he had a tenant turnover that's costing him $3,200. And then he said, this is basically all of my cash flow. And that's the mistake that most new investors make. Expenses do not impact cash flow. When we look at buying a property, there's several metrics that we use to buying a property, and I'll cover most of mine, but I'm going to say that we start with math. So we pick a market, we pick a strategy. So where are you going to invest? That's your market. We call it a footprint. I invested in 2 counties for about a decade. Now I've expanded it out to 2 more. My last purchase was in one of those new counties. But I invest locally within an hour. So that's my market. My strategy is buying and holding short, long-term rentals that are small multifamily. And Tuesday, I'm going to make a video this week coming up on why small multifamily prices are about to go through the roof, which doesn't suck if you own them. Can be great if you get in the window of opportunity, and might not be so great a couple of years from now. But that's my chosen strategy. I wanted to buy single family houses, but they don't cash flow in my area. So I moved on to small multifamily. I've house hacked to reach financial freedom. I house hacked twice, retired last year. And since then I purchased my 3rd house hack, which I'm living in now, doing a self-funded modified BRRRR. That's my goal now, is to finish this BRRRR project and never do another one again as long as I live, because it's not my thing. I like to buy rent-ready or already occupied properties because I have the binder strategy where I get my tenants to ask me to raise the rent. Makes it a lot easier to find cash flowing deals on the MLS. But let's look at this: $3,600 in cash flow, $3,200 in expenses, thinking most of his cash flow for the year is gone. When we run the numbers on a property, first we pick our market, then we pick a strategy, then we go to math. After math, there's still a list of things that we use to determine if a rental is something that we want to pursue or not. I like to do things that are going to help limit tenant turnover and provide me with several sources of tenants in case something happens, like a government shutdown, prolonged a pandemic, or a stock market crash. I like to invest with my properties at least 10 miles apart. So I'm pulling tenants from different sources. I like to invest where there are several economic drivers like a base, port, college, hospital, Boeing, or Amazon, large population, or something that would draw people in. I like to look at properties that are side-by-side small multifamilies, my preference, so that you don't have tenants living above or below each other, so you have less noise complaints. I look for I want washer dryer hookups because somebody using a laundromat or shared laundry is just waiting for a place to open, right? I have this criteria that I go through, but we look at math. When we look at math, some people will talk about the 1% rule. I've made a couple of videos on why that not only is it flawed, but it's outdated. I look at the There are people who look at a cash flow per door method, which is not what I use. I don't use the 1% rule. Not one of my properties has ever met the 1% rule. If I waited to find that metric, I'd still be waiting to buy one property, haven't met one yet. I hunted for properties using, as far as math goes, along with my other criteria, the yield method. Cash on cash return on investment. I wanted to know, based on how much it cost me to acquire the property and how much I profit every year, what is my yield? I take my annual profit divided by my cost to acquire to get my yield. The idea is, and I take this from One Rental at a Time by Michael Zuber, is you learn an area average yield and then you try to beat it. And for a long time, we would say, this is so you get a great deal. Matt the Lumberjack Landlord pointed out in one of his nanoseconds of genius, which he has a lot of, really what it does is learning your area average yield and then looking for a deal that beats that yield is actually a way to protect you from getting a bad deal. That totally makes sense. So I invest for yield. I was able to find 8 or 9%, and then I invested for 10s, right? I wanted to beat 10. First year, my properties have all beat 10. Not one of them was hitting the 1% rule. By third year, they're usually around 15 to 20% cash on cash return. And at about that time, they start hitting the 1% rule. A couple of years later, with mortgages going up a little because of insurance and taxes, but rents going up a lot because of my binder strategy, where my tenants asked me to raise the rent, which you can actually find a free course for at diontalk.com. You can do 3 things there. You can book an hour with me. You can get the free binder course. You can get my course on financial freedom for the lazy person there. In that yield calculation, it is annual profit divided by cost to acquire. Annual profit is all of your income. So that for me is rents, but in some cases it's rents, people pay for parking, coin-operated laundry, paying for storage, whatever ways you have of making money on your property. That's your income. Annual profit is when you take your annual income and you take out your expenses, principal, interest, taxes, and insurance, and we set aside for repairs, maintenance, and vacancy. So you can pick a percentage of that gross rent, right? I pick, since I don't have property management and I don't invest in any properties that have an HOA, I pick 5% for vacancy, even though I've never had one. My longest tenant turnover was 4 days between tenant leaving and tenant in place. So 4 days to get everything done was actually kind of challenging. So I put aside 5% for vacancy and 10% for repairs, maintenance, and vacancy of gross rents. What's left after taking out PITI, repairs, maintenance, and vacancy, is my profit. So I take that profit from a year and I divide it by my cost to acquire, which is down payment, closing costs, and immediate repairs, all the money it costs to get that place rent ready once I purchased it. So when this person, Chad, asked this question, and I'm going to play it again here so you can hear exactly what the question was.
And Chad's question is a really good one. It says, during a tenant turnover, what is the average percentage of annual cash flow that it takes to get a home ready for the next tenant? For example, I'm cashing $3,600 annually, and I need to turn it over for the next tenant, and it costs me $3,200. This is basically most of my cash flow.
So the $3,600 that they're cash flowing is cash flow. A portion of gross rents is being set aside for repairs, maintenance, and vacancies. So let's take an average. If I average out my rental, some rent for more because I have 3 and 4 bedroom places and I have some 2 bedroom places that rent for a little less. But if we average it out to $2,000 is my rent, my average rent. If we take that and we take that 15% that I'm setting aside for repairs, maintenance, and vacancy, that means every month the unit has $300, that's 15% of $2,000 in rent, being set aside in an account for repairs, maintenance, and vacancy. If you take $300 a month times 12 months, if my math is anywhere close, Matt was here, he would correct me, but that's $3,600 a year being set aside for repairs, maintenance, and vacancy, which means tenant turnover. So the $3,200 in expenses for this tenant turnover would have come out of that tenant paying their rent for the year. The hope And one of the reasons why my search criteria is I look for things, if you remember about 7 minutes ago, I said, my criteria includes physical aspects of the property that help limit tenant turnover. The average tenant stays in a house or small multifamily about 7 years. The average tenant stays in an apartment about 2 years. One of the many reasons why I don't invest in apartments is the higher turnover. I have tenants in place that were in the properties 15 years. I acquired them 5 or 7 years ago, and they're still there. So these are tenants that have been in their properties over 20 years. So you can keep tenants long-term, especially if you look for properties that have those side-by-side units, washer dryer hookups, 2 or more bedrooms and a garage, because more space equals more stuff. I allow pets because people don't like to relocate their animals. So I've helped limit tenant turnover. But let's say you had a turnover every single year and it somehow cost you $3,200. Every month, $300, 15% of your rent is being set aside in an account for repairs, maintenance, and vacancy. That gives you $3,600 to handle issues. Now the tenant moves out, you spend your $3,200. That leaves you $400 from this year's alone repairs, maintenance, and vacancy fund that is sitting in an account. You cash flow the $3,600, meaning that if you cash flow $3,600 and you only have $3,200 in expenses and you have $400 extra, now I'm going to prove the thumbnail. $3,600 minus the $3,200 in cash flow leaves you $400. So your $3,600 in cash flow and your $400 left over would give you $4,000 in cash flow that year. It's not actually how you do it. The $400 that you didn't use that year stays in the account because the repairs, maintenance, and vacancy doesn't just pay for the turnover of a tenant. It pays for the new roof in 15 years. It pays for the water heater or the now 4 refrigerators I've replaced this year. And the idea is a lot of landlords, if you look at this the way that Chad did, I have $3,600 coming in, I spent $3,200, I didn't make much money. If he had one more refrigerator go out and he paid $800 to put a refrigerator in his mind, he'd be negative $400 for the year. That's not how I look at it. In this example, with my $3,600 coming in and my $3,600 going for repairs, maintenance, and vacancy, I look forward to having expenses. Those 4 refrigerators that I've replaced this year is because over the last several years, 15% of my gross rents is getting set aside into an account to pay for repairs, maintenance, and vacancy. The tenants paid for my new refrigerators at my rentals. The tenants paid for my roofs at the places that needed them. My tenants replaced the garage door earlier this year. My tenants paid for the water heaters that I replaced earlier this year. As long as you keep a clear separation of your cash flow and the portion of gross rents that you're setting aside for repairs, maintenance, and vacancy as an investor, you will look forward to expenses at your rentals because that is your tenants' money being used to fix your properties, making them more likely to stay because you actually have the funds to take care of the property. One of the reasons people become slumlords is because they don't make enough money because they never raise the rents and they run their numbers poorly by looking at things like expenses as impacting their cash flow. So they don't want to fix things. They don't want to replace water heaters. They don't want to fix leaks because that impacts their cash flow. But when you can separate those two and you can look forward to those expenses because your tenants protect your assets with the money that you're setting aside from gross rents, it's a lot easier to want to grow your portfolio. Now, on Tuesdays, I normally answer every question. What I'm going to do, look through here really quick, is see if there's any questions today. I want to say howdy to everybody. Miguel Salty, thank you for showing up on a random Saturday live. Hustle Nation, howdy. Wealth Building Journey, it was great seeing you in the course today. Richard, howdy. Kenny, All-Nighter Hider, howdy. Hustle Nation, good to see you here. I invest only for appreciation. Awesome. I think that's like somebody asking me the LLC question to see if they could bait me into this. Give yourself a raise. I do that by using the binder strategy. I expected last year to make $168,000, but because of the binder strategy, I closed out at $203,000 without adding any more properties. Can't wait to meet you in Las Vegas come February 17th and 18th. One Rental at a Time is putting on an event. You can still find tickets at onerentalatatime.com. I hope to meet you there too. Looking forward to it. Miguel Salty, I'm starting at 28 with one rental. Congratulations, and hoping to continue to be fired by the age of 45 or before. I think by 38 is fairly reasonable, depending on your starting position. I think if you're in worse shape than I was, I found out about $89,000 in bad debt I didn't know existed till the divorce. I was a single parent with 3 kids. I started teaching at a truck driving school, making $17 an hour. So bad debt to income ratio, low income, a lot of expenses. It took a decade. So at 28, if your starting position is any better than mine was, I think 38 is entirely possible. If your goal is 45, I think you'll be killing it by then. I look forward to you, Miguel Salty, when the income snowball kicks in and the struggle isn't finding the next one with the patience to wait to find the next one. It's actually dealing with all of the cash flow that comes in and figuring out a way to put the money to work. Laura, howdy. I appreciate your comment on the 1% video the other day. Not one of my properties met the 1% rule, Laura, just like you. If I had waited, you said it didn't meet the 1% rule, but you got a 12% return. You can get a good cash on cash return, even though you don't hit the 1% rule. Bill, howdy, good to see you. The wealth building journey, he didn't set aside for maintenance, repairs, and vacancy, CapEx, and property management. Sounds like it does. What's worse is if he ran his numbers that way when he bought it, he bought a bad deal. Because to figure out your yield, you want to also set aside those monies, and then you wouldn't pursue one that only had $400 a year in cash flow if it costs a lot to acquire. John Smith, howdy. Thanks for great content as always. I've been trying to buy another rental in Northern Virginia as some time, but there's just no way of making any money, even with 25% down payment. So this is what shifted in the last couple of years, and I'll be wrapping this up here pretty soon. But for the last 5, 7, 8 years, speed was our friend, John. What we did is we wanted to make offers super fast. I wanted it within an hour or two of it hitting the MLS so that I can get my offer in before the seller realized how many offers they were going to get. They were waiving contingencies, over asking, and get them to accept my offer so they'd get the sunk cost theory so that they would want to deal with me even if a better offer came in. That's not what we're doing now. What we're doing now, what I'm doing now, and what I recommend, that's what I say when I say we, like a nurse, the royal we. How are we doing today? Is to watch days on market, John. It doesn't make sense at 25% down, but what if you watch something and it's on the market 3 or 4 times longer than what was normal for your market, and then you make a ridiculously low offer? I don't think it's an insulting offer. I think it's an offer that says, your property sat a long time. You have to admit it's kind of overpriced. I'm willing to solve your problem, but this is the price that it's going to take to do that. See if you get it to stick. I also ended up expanding my market out. I normally invest within just an hour of each other, but I put another 30 minutes on it. So I now have some properties that are probably an hour and 15 minutes apart. But I found some new markets where remote work has pushed people out as renters. So rents have gone up, but it hasn't pushed up the prices of properties because those people with remote work that can now live further away from work because they're only going to the office once or twice a week instead of every day, don't want to buy. Because what if their boss makes them come back to the office next year? But they're out and they're renting. So rents have gone up in this area, but prices haven't caught up yet. That might be happening a little bit further out than where you're looking. Thank you, Wealth Building Journey, for putting in the link there. Johnny Cashflow Ramirez, howdy. John Smith, 2-2. Condos start at 300 to 340,000. Rent is 21 to 2,200. Also, on top of that, John, I would take condos off my list of things I would look at. I will not own a rental in an HOA. There's a couple of reasons. One, HOA fee can double or triple. You don't have control. You could probably factor that into increased rents. But 2, HOA boards are generally made up of, professional term here, douchebags who have nothing better than to take their time and mess with other property owners there. So the board is usually a problem. But the third thing is, and this is the deal killer for me with HOAs, there's actually 2. One is that the random assessment. You could be in a situation like Matt the Lumberjack Landlord, where he got a random assessment for over $70,000 because they wanted to re-side everything, and you just got to pay it. He ended up selling. But the fourth thing that bothers me about HOAs and is actually a real deal killer for me is a friend of mine owned a property, and about 3 years ago, he went through this. So he had a tenant in it for 5 years, and then 3 years ago, his tenant moved out. Well, the CCNRs, the codes for the HOA said that they were allowed to have 20% of the units in the entire area could be rentals. And they weren't really paying attention to it. So when his tenant moved out, the HOA was at about 30% rental units. So he couldn't put another tenant in place. His options were move in, leave it vacant, or sell it because of the HOA. So if you're looking at condos, I think I might expand your market out a little bit, and then I would look at any type of investing where you can find the yield you're looking for that isn't in an HOA. Just a suggestion. I can't tell you what to do. There's no one right way to do this, but there is a one right way for you. And then when you say, John, when you say no duplex, triplex in Northern Virginia, how are you looking? Because they will not show up on Redfin, Zillow, or Realtor.com. They will only show up on the MLS, and they will be gone like that. And if they do show up on any of those other platforms, it'll be 2 or 3 months after they've closed. They'll show up as pending. Multiple agents with auto searches set up, but there's an asset class you might be missing. Condos, townhomes, small multifamily. A lot of investors forget to look for house with ADU, so an accessory dwelling unit, 2 houses, 1 property. Look, works like a duplex. I think the numbers do, but you get true single family lending. And there are places where it could be 2 5-bedroom houses. One of them is considered an ADU. Yes, in the last 15 to 20 years, there's new restrictions on ADUs where they're generally limited in size. But if they've been there for a while and they haven't subdivided the property, it can be 2 full houses. But you can't control what the listing agent is going to call it. So when you search on the MLS with several different agents with searches set up, you want to look for ADU, DADU, JADU, accessory dwelling unit, auxiliary dwelling unit, detached auxiliary, accessory, granny flat, mother-in-law house. Make sure your search includes all of the things that it could be, because you eliminate a lot of the competition. A lot of investors are looking for small multifamily or single family houses, so the ADU thing isn't searched for as much. And homeowners that find one with an ADU sometimes don't want it because they're not looking to have tenants. And why is my screen messing up? RAI Stoners, howdy. Can you wish Mary a happy birthday while she's making pasta in the kitchen while listening? Happy birthday, Mary. I hope it's a day full of awesome. Josh will be cooking for you, although making pasta, it's probably fun. I look forward to, in the next couple of weeks, connecting on Monday or Tuesday, one of you guys' days off, coming over, checking out your new unit and seeing how the rehab is going. I will take a note to remember a birthday present. I will see you there. Miguel Salty, I agree. The wealth building journey. I rather small cash flow that's accurate compared to large cash flow for the unexpected. Absolutely, exactly. Totally agree. And then I saw, was it my chat moved? I think it was. Somebody said hit the like button, which is I would appreciate if you would do that. I think there's 22 likes so far. That's not a bad ratio, but I appreciate the support. And this is from Kenny. Expenses that are depreciated over time will be offset by the appreciation. Interesting way of looking at it. Bill, I have a few YouTube videos that I'd like to share sometime. You should email me because I am always looking for questions that people ask that would give me ideas on what you would like to learn. One of the reasons I like to do these live streams is I actually recorded, didn't like it, in an edited version of the answer to the question that came up on Ken and Daniil's channel. But when you ask questions like this during a live stream, you see what is important to an investor. If I have an answer and it comes out quick, it means it's something I've had to think about and dealt with repeatedly. But if you ask a question and I don't know, or I say, oh, CPA would be the best way to go, it means it doesn't matter, because I want you to have the same information so you can make quick decisions to know if you should keep pursuing a property or if it's now a waste of time. I think I will be wrapping up there after I see Wissam's howdy thing here on the MLS. They said no showing until offer accepted. What should I do in this situation, please? I can't submit an offer on duplex I didn't see or check. I'm glad I saw that there, and I'm glad I can wrap up with this question, because I have never, ever seen a property, and then made an offer. I make an offer at numbers that make sense to me, because you need to know your area average rents. You need to know the areas to avoid. I know the areas I know the specific streets and neighborhoods in my investing area that I would not own properties in. So I know that there's no deal breakers in the area, and I know that the math works because I know area average rents. I know what my yield would be. I use the CDS rental calculator app to do that really quick. It's actually just an app on your phone. Once you're under contract, so I'll make 20 offers before I get one accepted, or sometimes 20 offers before I get a counter, to where I have to think if I want to accept their counter. Can you imagine going to 20 places and taking up your agent's time and spending that much time driving around looking at properties versus you make 20 offers, you finally get one accepted. You have an appraisal contingency, so your financing contingency if it doesn't appraise, or if for some reason you can't get qualified for the funding, then you can back out and keep your earnest money. But you have an inspection period. It is not important to me that I have an inspection done. What's important is that I have 5 to 10 days, depending on the market we're in. A longer market and longer days for an inspection period during a buyer's market, shorter during a seller's market to make it look more attractive. But those 5 to 10 days is to make up your mind. That's when you go do your viewing. That seller is listing it the way that I make my offers as a buyer. I never want to see the inside of a property until I'm making an offer. To me, it would be a complete waste of time as long as you have those contingencies in place. Never waive your inspection contingency, not because I want an inspection done, although I have had one done on every purchase. I want the period of time to go and look to see, is the parking good? Is it next to something noisy? Are there power lines above it? Is there something I wouldn't have realized from a Google search? What does the neighborhood, the next houses over look like? All of that happens once we're under contract. So I think it's a great question. I think a new investor, when we're a home buyer, you just want to buy a house, yes, you're going to probably sign an exclusivity agreement with a realtor. You're probably going to go look at properties before you make an offer. But as long as you, as an investor, we make so many offers, I couldn't possibly go look at all of them. I wouldn't want to. So if you're just a home buyer and not an investor, not just a home buyer, but if you are a home buyer and not an investor, you can still put in an inspection period. Right? So they would have to accept your price. Then you would go and look. And now you get to go and look. It's not costing you or your agent anything. So where this could be bad is, let's say you're in the $300,000 range and you start making $350,000 offers just so you can go look at properties. That would probably irritate your agent because you're going to back out. Know your numbers, know which offer is going to get you the yield that you're actually looking for, and only make those offers and explain to your agent, I understand that if I go and I see these things that I find out once we're under contract, I'm going to back out. Your agent will understand. Thank you all for hanging out with me on a random Saturday live. And I hope my explanation explained to you how 3,600 minus 3,200 is actually 4,000. Until my next video, thanks for coming to my Dion Talk.